Over the last few weeks, we've seen the short-term Treasury bill rates edge lower, and this week in particular, we saw the 3-month Treasury bill rates fall by roughly 0.29% to 15.64%, and the 1-year Treasury bill rates fall by 2 basis points, 12.99%. However, we saw the long-term Treasury bond rates edge higher during the week, where the 5-year Treasury bond yields edged up by almost 50 basis points. From a credit perspective, we saw the credit numbers pick up during the month of September, where the Sri Lankan banks have lent close to 69 billion rupees in terms of lending, which is one of the highest figures that we've seen over the last 3-4 months. And we believe that the demand for credit is stemming from the seasonal imports that are coming in for the month of December. Overall, from a market perspective, we are seeing a slight pickup in consumption of FMCG goods. However, consumer discretionary spending remains very subdued going into the Christmas season. Also, the market is eagerly looking forward to the fiscal reforms that will come in the November 13 budget. And a lot of concern is around tax collections and how the government will be looking at increasing tax revenues, which are expected to increase by roughly 30% going into 2024. On the external front, we saw the currency stabilize at around 326 to 327 rupees to the dollar, amidst a bit of pressure on the balance of payments owing to the seasonal demand coming in for imports. However, the good news is that crude oil prices edged lower roughly by $3 to the barrel this week, and this is owing to less concerns surrounding supply disruptions from the Palestine-Israel war, and also US increasing its oil production substantially during the last quarter. As a result, we don't see too much pressure on commodity prices going into the December season. From a financial perspective, we also saw money exiting from both equity and debt markets, and we feel that the stronger dollar is exerting pressure on money from frontier markets moving in developed markets.